Normally, I'd say happy Thursday. Well, it is Thursday. It's late Thursday. So I have a feeling it's happy Friday, team. Either way, happy whatever day it is. Guys, it's March. I'm glad February's gone from a mortgage standpoint, but March isn't starting out much better. So let's take a look at things here. Not good. So if you've watched these videos long enough, you know that this isn't a good sign. All that red and all this down decline means higher interest rates. It's opposite here. This is mortgage-backed securities. Check this out, just sliding. No bueno, guys. Rates are up easy over half a point, maybe even, I know, more just since January. So what started all this? By the way, rates right now, according to the mortgagenewsdaily.com, 7.1 as we end this fine, wonderful Thursday afternoon, evening, 7.1. And that has some points associated with the team. So that's incredible. So for all those that locked in January, and we said to do it, congratulations. We can't predict the future, guys. Yes, I do think rates can come lower, eventually I may be right. But I didn't predict this. And I don't know a soul that predicted February to do what it did. Why did it do this, guys? It was job reports. So early February, first Friday of the month, they reported job reports. We'll get to that in a second. And then inflation came out. So job reports, having a lot of jobs created, is inflationary. And then right after that, a week later, inflation numbers came in just a touch higher. But here's the deal, guys, as we've been saying all along, we called the peak in inflation correctly in November. We said it was coming, and it did, peaked in November. It's been coming down. Yes, it went up last month. Retail sales were super strong for January. I think some of that could be just, a whole bunch of different factors, maybe a good holiday season. But the reality is overall inflation's coming down. You can see this little graph on the left, CPI and PC, those are the two main components. And what do we mean by core? Core strips out food and energy. The Fed can't grow more crops. The Fed can't drill more oil. All the other stuff it can impact from raising their rates and doing things. But we are going to win this thing. It will happen. I'm confident. Unfortunately, the Fed, and that's part of what drives rates up. Some of these Fed members don't get what happened. And here's what I mean. So January's numbers came out on first Friday in February, and they said somewhere, it depends on which one you want to look at, somewhere between 500 and 800,000 jobs were created. And I talked about this a couple of weeks back when it happened. There's just no way. And here's why. January, first of all, they changed their formula. The Bureau of Labor and Statistics, they changed kind of how they calculate things. So it's not apples to apples to the past. In addition to that, they seasonally adjust the number. So they say, once a year, we got to take into account all this other stuff. That's where the fluff comes in. I think jobs could have been closer to millions lost. And if you look, and this isn't proof, but just FYI, look at the job openings since February of 2020. So for the last 3 years, check out what the jobs posting. And this is between Indeed, ZipRecruiter. I don't know, Jolts. Maybe that's a big one and linked up. I don't know. But point is, there's no way hiring's happening when jobs for the last 12 months, when job openings have been on the decline. There's just no way. So I think that's going to come out. I know it'll come out next week, but the numbers next week, I think, will justify and show that next Friday, the job reports for January was a flub, and it falls. And it's just, I'm not saying they manipulated. I'm just saying they're not right. So I think this is going to, next Friday, hopefully we start seeing, I hate to say that. I don't want people to lose their jobs, but they are anyway. So you might as well report the correct number. That will help our rates. Remember, I've been saying May, circle May, and May 10th on your calendars. That's when I think shelter CPI is going to help. Because again, depends on which reading, CPI versus PC, but it's easy, 30 to 40% shelters, 30 to 40% of these inflation numbers, guys. And look at what's happening, right? So the year over year change supposedly still going up, showing inflation at about 7.9. The reality is, because again, this data lags coming in. So I think May it'll start reporting. Check out the decline in apartment listings and rent year over year. Rents aren't going up as aggressive as they were. They've come down. It just hasn't been showing up in our inflation numbers. So that's why I do think the May's numbers are going to show some really big numbers there. Home prices, I'm a broken record. I get it. But guys, when you look at this, and it's the national, it's the top 20 cities and then the national cities. And FHFA, just so you know, is like Fannie Freddie. So anybody with a mortgage, look, guys, year over year change, through December of 2022, still up. The decline from the peak, a whopping 2.7%. Big deal. Here's why I say big deal, or 4.8. Fine, take 4.8, take the big one. Guess what? Check this out, guys. This is what values have started doing, and they've been going up and up and up. And so much so, investors are coming in. People are like, oh, the demand. No, there are just more buyers. There's not just more buyers, there's more institutional money. These, what do they call these? Absentee owners. So investment properties, second homes. Sorry, I got this ugly looking data. I put the code in here twice. That's my fault, team. But I was astounded. In some markets, like 75% of the investor loans are done in cash, which is wild. And it makes it hard for people to compete. And that keeps prices elevated because the demand is there. Check this out. Speaking of elevated prices, since 2020, prices have increased a whopping $140,000. It's 42% increase. That is wild. And again, going back to this in San Antonio, apparently 82% of the homes are now purchased in cash compared to like 5 years ago when it was about 50%. So I'm just telling you, it's still a good market. And people say, oh, the rates are 7. Dude, that sucks. There's nobody here that's going to say that's a good thing. Here's what I will tell you. Maybe you can get that seller to come off their price 10, 15 grand. Who knows? Try it. Because now a lot of buyers are back on the sidelines. Go see if you can do it. Because guess what? I do think rates can and will eventually come back down. Maybe it's 12, maybe it's 24 months, but your rate's not forever. If you're paying $200 a month extra because these rates are higher now, that's $2,400 a year. If you get the price of the home that you love for 10 grand less, you win. I know that's a glass half full. It's a salesman job, but the reality is that's still math. Math is hard. Look, big cities, Dallas isn't in here. Fine. But this is where Gen Z's going. Austin, good for them. You know, hook them. I went there. Here's where people are leaving. And here's where people are going. Classic. When I took the screenshot, is over it. Basically, people are coming here. If you look where the states are, California, that's the big one. We talk to Californians, literally a bunch of them weekly, coming here because of where we are. So again, oh, there it is, Texas down the bottom left. It just, you know, little blue, but people are coming here, guys. Dallas-Fort Worth's protected. Our values are protected. So now is a good time to buy. Reminder, both VA and FHA, and I'm not going to get into the details of the chart. Basically, FHA and VA made things less expensive, meaning awesome. Homeowners can save hundreds of dollars, like $800 to $1,000 a year on their payments. So it's the mortgage insurance for FHA, the funding fee for VA, Fannie and Freddie, you know, you put a thumb down and say, boo. You know, they made it to where if somebody has a debt ratio of 40% or more, rates just went up 0.1, 0.2. That stinks. Nobody likes it, but good thing for FHA and VA. So if you're a first time buyer or just a low down payment, those are awesome. Things just got less expensive. That's wonderful. Oh, look at this question of the week. How does credit impact our interest rates? Depends on the program. So higher is better, right? That's always a good thing. Higher scores are better scores, but programs like VA and FHA, they don't hit you like other programs might, like conventional, where it's every 20 points does matter. So guys, higher is better, but don't let that like stop you from moving forward. We got a credit simulator. We can play like what if you paid this down to this much or paid this off completely or did this. It'll show what it'll project to be, and we can work with you guys to figure out how that's going to impact your rate and whether it's worth fixing that first or moving forward today. Guys, let's get social, baby. Hit us up. We'd love it. We'd appreciate it. Follow us, like, subscribe, comment, all that fun stuff. We like seeing what you guys are doing. Thank you as always for watching. And it is Thursday, and I think it's supposed to get bad tonight. So careful for that egg size hail or whatever's coming our way. You guys are awesome. Have a great week.